There's a series of different funds that we run at Harvest, the majority of which is a short volatility fund.
How'd that do in the last couple of days?
It struggled a little bit, but it's come back. It's been fine. I mean, for the month, it's under 1% loss.
Wow.
So, and we'll see what today brings. It looks like we're heading back towards unchanged, which will be good.
So you must not be leveraged.
We're not. And
Okay.
that's the point on this whole story that I think most people are missing. Short volatility is not the story of what happened. What really happened here was unrealized leverage, right? Options are leveraged instruments. And when you package them in an ETF and then allow leverage on that and then pitch it as an ETF or like a stock, there's no way of telling how that's going to behave. I mean, when I was reading on Monday night about a poison pill being enacted in a volatility instrument, I'm not an investment banker, right? I don't know deals and stuff like that, but suddenly everyone's combing through prospectuses to find out.
So we don't, diss the ETF market. That was an ETN. That was an exchange.
A note, not a fund.
It
right?
is.
And so
and
the ETF guys are not happy with the bad press they're getting on this.
But you saw BlackRock came out, said we're not in this business.
Listen, Larry Fink came out and said they should be regulated. Jim Cramer has been very vocal and correctly so, but once again, it's a leverage issue.
Here's the thing about regulation. People always want leverage. You go back to 1929, and people were buying on margin.
Exactly.
So they raised the margin requirements, and then you try to tamp down leverage here. No, you're not allowed to do that. No. And then you know what happens when money gets cheap? People buy 6 houses because they want leverage. They love leverage. When it works, it's really good.
The point is people didn't understand what they owned
Exactly.
in the ETN.
People want.
It's okay to go to zero if you don't know what you're buying. That's a good lesson.
If you're looking for leverage in a product, you can go and get Reg T margin from your bank and get leverage. And you can assess your risk. Listen, risk is a good thing.
But it's so much easier just to buy this ETN.
And it's
right?
so much easier to lose 90% in a day.
Yes.
And if you know that you have the probability of losing 90% in a day, you may go to that product, ETN, not ETF, ETN, and go and do your best and say, listen, I've doubled my money in a year. Now I'm going to take all this money off the table because it could all be gone tomorrow.
Right.
The flip side of it, and this is like volatility is volatile, obviously, but the move that we saw in volatility doesn't happen in a lot of asset classes. So if you saw crude oil go from $150 to $20 overnight, or $20 to $150, and there was a leveraged product on that, it's math, right? They have to reassess where they are, and you're log normally bound by zero, right? You can't go below zero, so you have this poison pill.
Your firm has an interesting fee structure. You're not a 2 and 20 hedge fund.
Right. No, we're not.
What do you charge?
Less than your funds.
Rick Santelli, we haven't forgotten about you. Weigh in here about what you think in terms of volatility and leverage.
I want to weigh in here. First of all, the axiom that's been on the trading floors ever since 1987 about volatility, when that issue in 1987 brought firms down that allowed option traders to be short volatility, was, moments of terror surrounded by months of boredom. That pretty much summarizes volatility. But I agree a lot with Dennis and Mr. Wonderful. I think much of the issue that occurred with respect to the drop in equities based on volatility, I think that the people that own those products knew exactly what they had. This whole notion of risk parity and vol control in portfolios and all the products that hedge funds either market or use, insurance companies, pension funds, it's actually quite simple. They own more stocks, for example, when vol's low, and they own less stocks when it's high, and they have all kinds of models and overlays to deal with this. But the issue is, just like subprime mortgages, when you get an inordinate amount of traders and positions laser focused on any one thing, in this case volatility, whether it's ETNs, ETFs, portfolio control, risk parity, that when it moves, the shock waves are large. So it isn't that vol's a problem, it's the problem we've always had. Michelle alluded to, is that customers are smart and they come up with creative ideas. The problem is creative ideas spread like wildfire and you get too many of them.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.